Hey everyone, happy Thursday, May 30th. It's about a little bit before 10 a.m. on the West Coast, and it's time for another market update. Hope everybody had a great Memorial Day weekend. Because of Memorial Day weekend, Monday being off, it was a shorter week in the markets, but still some important news came out, so let's get right into it. First off, we had March appreciation numbers for FHFA and Case-Shiller. These are the two main appreciation reports. March, FHA and Case-Shiller kind of lag a little bit. We're at the end of May here, and we're just getting the March numbers. But let's take a closer look at those numbers, and they continue to go up. So Case-Shiller seasonally adjusted was up 0.3%, non-seasonally adjusted up 1.3%. Unchanged year over year at 6.5%. Remember, this month's numbers is always replacing last year at this time's number. FHFA, which unlike Case-Shiller does not include jumbo loans or cash deals, that came in at seasonally adjusted up 0.1% month over month and dropped a little bit year over year from 7% to 6.7%. But keep in mind, again, it was because last March was a stronger number in FHFA. So, home appreciation continues to stay strong. Good for homeowners. In chart form, this was interesting to look at. This is the monthly, this is basically the FHFA home price index going back to January of 1991. Obviously, you can see the downturn years right there where we had a little bit of a housing recession or a big housing recession. But, kind of almost a straight line, since then. You can kind of connect it right there. If we didn't have that, it would be kind of the trajectory it was headed on. Keep in mind, at this point, we had about 4 million homes available nationwide. This time right now we have about 1.5, which has been going up, but still, quite a bit of ways from that. And we have about 39 million more people, I think, in the population compared to then. So just interesting to look how much home prices have gone up since then. And again, this is not counting jumbo or cash deals. This is just the, generally the lower price loans. Next thing we got this week, we got April pending home sales, and this came in really low. It was supposed to be down a little bit, like negative 0.6%. It came in at negative 7.7% month over month, and now negative 7.4% year over year. Taking a closer look, like I said, negative 7.4% year over year. And as MBS Highway points out right here, in April, rates were at their highest recent point. I think they got above 7.5. So these are pending home sales. These people went under contract in the month of April when, I guess rates were at their highest. So that probably made these numbers a little bit worse. Whereas, rates, we've had a little bit of a rally here in May. So when we get May's numbers, these pending home sales might rebound a little bit. But still, not good to see, activity drop off that much for, anybody in the industry and anybody looking. Initial jobless claims, again, this is very important. The Fed is paying very, very close attention to inflation, which we'll get to in a second, and job claims. And job claims still staying pretty relatively low, a little higher than expected, 219,000. Continuing claims went up again, but still these are pretty low numbers, historically. So we're going to have to keep a close eye on that. The lower these stay, the lower unemployment stays, the more the Fed will be emboldened to keep rates where they're at, which we don't want. Next thing, a couple miscellaneous things. So really the two things that drove the markets the most this week in a short week, just Tuesday through to today, is there were some note auctions, 2 and 5 and 7 year note auctions. These is more on the technical side, investors, buying up notes. And there was a lot of supply out there and not much demand at all. Horrible auctions on the technical side, just not a lot of demand. That hurt bond pricing a lot, and that's what affects mortgage rates. So that was the negative that happened this week, really, that, the most affected the markets. And then the most positive thing that came out today was the second reading of Q1 GDP came out. The last reading was at 1.6% growth. This one came in at 1.3% growth, so obviously came back a little bit. The bond market like that, showing a slowdown in economic activity. Again, the more the economy slows down, the more inflation slows down. Hopefully the Fed wants to spur the economy to grow at some point and cuts rates. And then also there's a component of PCE inflation, which we're going to get tomorrow, the full report, but they include a quarterly PCE number in there, and that came in lower than expected. So the bond market's like that, anything lower inflation is good for us, obviously. So where does that leave us? The average 30-year, as of right now, it looks like is about 7.29%. Last week, we were at 7.17%. Keep in mind, this is an average. This is a lender survey that Mortgage News Daily does. This is not necessarily what you get. I like to look at it just because you kind of get an idea, whoever you are, whatever you're looking at, kind of like where mortgage rates are going. This is people, putting probably 40% plus down, have 800 plus credit scores, and probably are getting charged a decent discount amount. But like I said, it's a good barometer to just kind of keep track. So, no matter what your credit is, your rate probably would have gone up, maybe 1/10 of a point over this last week with, what things that had happened. So just keep that in mind. And then important dates coming up. We have tomorrow we have the Fed's favorite form of inflation. That's the PCE report that comes out. Markets weren't really expecting much help there, just based on numbers. Depending on if they round up or down, it might come in as no change, maybe a little bit of change. Remember, the Fed's really paying attention to that core rate, which strips out food and energy costs. So we don't expect a lot of help there, but today's GDP reading kind of made us everybody think maybe we will get some help on that inflation front tomorrow. So that would be very, very, very positive if we did, because we need some help on that front because it's kind of stalled. And then the next thing coming up next week is that BLS jobs report. That's the big one. Unemployment goes up. Really good for us. Not good for people that lose their jobs. Again, it's one of those catch-22s with all this, is that we kind of need the economy to slow down. We need unemployment to go up if we want to see mortgage rates go down, quite a bit anytime soon. So not the best on a short week because of those auctions, but, like I said, hopefully that inflation report comes in our favor tomorrow. Good to see appreciation staying strong, but let's see, hopefully rates come down and we get more of that pending home sales, better activity. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week. Thanks a lot, everybody.